Nigeria's central bank yesterday kept its benchmark interest rate unchanged for the second time in a row, as many had expected, while still noting relative improvements in key macroeconomic indicators that support a moderation in prices in the medium term. Ahead of the meeting, there was pressure to consider a modest cut in view of the pain borne by interest-sensitive sectors. Hello, welcome to this special edition of Global Business Insights, where we look closer at headlines moving markets and offer perspectives on the business environment. This episode focuses on the Nigeria Central Bank Monetary Policy Committee decision. First, let's listen to the Central Bank of Nigeria Governor Olayemi Cardoso, his remarks after the MPC meeting.
MPC of the Central Bank of Nigeria, CBN, held its 300th meeting on the 19th and 20th of May 2025. The committee was unanimous in its decision to hold policy and thus decided as follows. 1. Retain the MPR at 27.50%. 2. Retain the asymmetric corridor around the MPR at plus 500 to minus 100 basis points. 3. Retain the cash reserve ratio of deposit money banks at 50% and merchant banks at 16%. 4. Retain the liquidity ratio at 30%. Considerations. The MPC noted the relative improvements in some key macroeconomic indicators, which are expected to support the overall moderation in prices in the near to medium term. These include the progressive narrowing of the gap between the Nigeria foreign exchange market, NIFEM, and Bureau de Change, BDC windows, the positive balance of payments position, and easing price of PMS. Members also noted with satisfaction the progressive moderation in food inflation and therefore commended the government for implementing measures to increase food supply, as well as stepping up the fight against insecurity, especially in farming communities. The MPC thus encouraged security agencies to sustain the momentum while government provides necessary inputs to farmers to further boost food production. The committee, however, acknowledged underlying inflationary pressures driven largely by high electricity prices, persistent foreign exchange demand pressure, and other legacy structural factors. The MPC noted new policies introduced by the federal government to boost local production, reduce foreign currency demand pressures, and thus lessen the pass-through to domestic prices. Given the relative stability observed in the foreign exchange market, members urged the bank to sustain the implementation of the ongoing reforms to further boost market confidence. The committee also called on the fiscal authority to strengthen current efforts at enhancing foreign exchange earnings, especially from gas, oil, and non-oil exports. The MPC, however, expressed concerns about the recent decline in crude oil prices attributable to increased production by non-OPEC members, as well as uncertainties associated with U.S. trade policy, which present new challenges for fiscal receipts and budget implementation. The committee reaffirmed the continued stability of the banking system following notable improvements in key performance indicators and observed the appreciable progress in the ongoing recapitalization exercise. Members thus called on the bank to sustain its effective oversight of the industry to ensure compliance with regulatory and macroprudential guidelines. On the strength of these considerations and driven by the continued uncertain policy environment exacerbated by ongoing global shocks, members weighed the available policy options and were unanimous in their decision to hold policy to enable a better understanding of near-term developments. Members reaffirmed their commitment to prioritize policies targeted at anchoring inflation expectations and easing exchange rate pressure. Key developments in the domestic and global economies. According to the National Bureau of Statistics, NBS, headline inflation year-on-year declined to 23.71% in April 2025, compared with 24.23% in March 2025. On a month-on-month basis, it also declined to 1.86% in April 2025 from 3.9% in the previous month. Both food and core components contributed to the decline in inflation in the period. Food inflation eased further to 21.26% in April 2025 from 21.79% in the previous period. Core inflation also declined to 23.39% in April 2025, compared with 24.43% in March. Real GDP year-on-year grew by 3.84% in the fourth quarter of 2024, compared with 3.46% in the preceding quarter. This improvement was driven by both the oil and non-oil sectors, with the services sector being the major contributor. Gross external reserves increased by 2.85% to $38.90 billion as at 16th of May 2025, from $37.82 billion at end of March 2025. Members were thus unanimous in their resolution to maintain close surveillance of developments in both the domestic and global environments to enable appropriate policy response to emerging shocks.
The decision was unanimous and all members were at the monetary policy meeting as they considered all the relevant factors, especially inflation. The decision was somewhat cautiously hawkish, similar to most apex banks waiting for better clarity on the inflation trajectory, also noting the high level of uncertainty still playing out in the external context. We typically do not get much guidance from the Nigeria apex banks, and there was little, albeit cautious, signaling beyond showing a wait-and-see mode. A single data print with the falling inflation was definitely unconvincing to establish confidence needed that the time was right to begin easing. The decision to hold could also be to allow more time, given the normal lag, for the restrictive policy environment to have its full effect on demand factors, pressures to reduce inflation, while also allowing fiscal side to play its own part. The latest Purchasing Managers Index data, that's economic activity, also shows much resilience despite the high interest rates. Stanbic IBTC Bank Nigeria PMI inched slightly lower to 54.2 in April 2025 from over a one-year high of 54.3 in the previous month. Still, it also was the fifth consecutive month of expansion in the private sector as output growth remained robust. With decent PMI, there is less panic about economic pain, and the MPC must be encouraged by the resilience evident in the data to wait to be more certain about dropping inflation before easing. Most important, of course, is need for caution to avoid premature easing and reversing recent gains in bringing down inflation. Analysts also applauded progress made in Naira stability, even as the governor said members of the MPC voiced concerns over the recent drop in crude oil prices and uncertainties linked to U.S. trade policy, which could pose new challenges for income, the value of the Naira, and budget execution. My sense is if we see May and June inflation data still trending downwards and less uncertainty as trade tensions settle, there is a decent chance that the next decision will be a cut. On Wall Street, S&P 500 fell for the first time in over a week as the market's latest run finally ran out of steam. It was indeed a slow day for Wall Street yesterday as traders look for catalysts to inform their investment decisions. In the UK, an important catalyst could be the latest inflation read, which just came out. Investors expect fewer Bank of England rate cuts in 2025, and the pound jumped, touching the highest level against the dollar since February 2022, as UK consumer price inflation rose 3.5% in April. This was faster than estimate for a 3.3% jump, also higher than the Bank of England forecast of 3.4%. On a monthly basis, CPI rose 1.2%, also exceeding the 1% estimate. Core inflation rose 3.8% on a yearly basis compared to the 3.6% expected, while services inflation jumped to 5.4%, well above the 4.8% estimate. The Bank of England lowered interest rates by a quarter point to 4.25% on the 8th of May. The Bank of England previously had said it expects inflation to peak at 3.7% due to higher gas and electricity prices between July and September 2025, before dropping back to its 2% target. Asia-Pacific markets closed mostly higher as Wall Street paused a six-day winning streak. Oil prices were up more than 1% after reports that Israel is preparing a strike on Iranian nuclear facilities, raising concerns on supply availability in a key oil-producing region. Well, that's it on this special edition of Global Business Insights. Thanks for watching. This is Bode Osho Sami.